Kyla Scanlon, In This Economy, How Money and Markets Really Work. Get ready to unravel the complexities of our economic system with Kyla Scanlon's In This Economy, How Money and Markets Really Work. This book summary offers a fascinating exploration of what underpins the everyday transactions we take for granted, like the $5 bill for your latte. At its heart, money is a social construct based on trust, functioning as a medium of exchange, store of value, and unit of account. Delve into the intricate process of money creation through fractional reserve banking and discover how banks navigate the risky waters of lending. From the 2008 financial crisis to the US dollar's dominance and challenges, Scanlon explains the global shifts in economic power. Additionally, explore the significance and limitations of GDP in capturing economic success, alongside the dynamics of stock and bond markets. Finally, understand the pivotal role of central banks, with a focus on the Federal Reserve's influence on the economy. This summary demystifies complex notions in a user-friendly language, making it accessible to all.
The Currency Chronicles. Imagine walking into a coffee shop and trading a piece of paper for a freshly brewed latte. What breathes life into that paper, transforming it into money? At its heart, money is a social pact sustained by our collective trust. It functions as a medium of exchange, a store of value, and a unit of account. Essentially, it's a universal language enabling trade, saving, and pricing everything from daily necessities to opulent indulgences. In our modern digital universe, money has metamorphosed beyond seashells and gold-laden caravans to the intangible realm of electronic transactions, where it seamlessly shuttles between accounts in mere seconds. The birth of money isn't confined to the clatter of minting machines, it's animated through fractional reserve banking. When you deposit funds, banks retain only a fraction and lend the rest, spawning new money as these loans circulate and are redeposited. Yet, banks tread a fine line, balancing their ledgers between loans and customer deposits, given the inherent risks of lending. Prudence is paramount, requiring consideration of borrower reliability and prevailing economic conditions. To shield themselves from potential losses, banks implement risk management tactics like diversifying loans and leveraging sophisticated financial instruments. However, even with these precautions, pitfalls exist, as dramatically illustrated by the 2008 financial crisis, when overleveraged banks unraveled the global economy, highlighting the necessity for vigilant regulation and sound risk strategies. At the epicenter of global finance stands the US dollar, commanding respect as the reserve currency due to America's robust economic foundation and thriving financial markets. In turbulent times, the dollar becomes a sanctuary for investors, buoying its value against other currencies. Despite its prevailing dominance, change looms on the horizon. Emerging players like China are nudging the financial hierarchy, advocating for their own currencies and devising alternative systems. While an immediate overhaul of this monetary hegemony is improbable, these evolving dynamics likely foreshadow a transformative shift in the global currency landscape. Beyond GDP. Picture the economic landscape as a sprawling canvas where gross domestic product, or GDP, takes center stage. GDP quantifies the total value of finished goods and services produced within a nation annually, calculated as the sum of consumption, government purchases, investment, and net exports. Consumption dominates this mix, encompassing everything from durable goods like cars to everyday items like gasoline, along with services that fuel the economy. With rising GDP comes a sense of national prosperity, more goods, services, higher incomes, and improved living standards. Yet, this measurement, long revered for signaling economic success, has notable blind spots, particularly in our digital age. The rapid rise of digital products such as apps and social media remains elusive in traditional GDP measures. Many of these services, often free to users and ad-driven, muddy how we assess value. Beyond digital dilemmas, GDP grapples with valuing intangible assets, think intellectual property or brand influence. These elements drive economic growth but slip through GDP's conventional framework. Then, there's the broader question of its relevance to genuine well-being. Economic growth may occur, but if it coexists with income inequality or environmental degradation, can we truly claim progress? GDP's narrow focus misses these vital aspects of societal health. Technology, too, reveals the cracks in GDP's armor. Despite groundbreaking advancements, productivity growth has stalled, a paradox that GDP fails to unravel. This points to the metric's inability to capture the real efficiencies tech innovations foster. Such insights pave the way for alternative measures, crucial for painting a fuller picture of economic vitality. In modern times, a reassessment is needed. Moving beyond GDP involves embracing a wide lens that considers social, environmental, and technological impacts. Developing new metrics can offer a more detailed and accurate reflection of our world's complexities, guiding decisions toward a just, sustainable, and thriving future. Financial powerhouses unveiled. Picture the vibrant scene of a stock exchange, traders in constant motion, fortunes changing at a breathless pace. Here, both companies and investors engage in swift financial exchanges. By selling shares or issuing bonds, businesses fuel expansion and innovation, while investors endeavor to grow their wealth. Yet, there's more at play than mere transactions. Markets are crucial in distributing risk across millions of participants, safeguarding the financial ecosystem from crippling chain reactions. A key to this safety net is exchange-traded funds, ETFs. By enabling investors to buy into a diverse portfolio of stocks within a single purchase, ETFs offer a straightforward way to achieve diversification without the gamble of choosing individual stocks. However, this convenience has a flip side. With giants like BlackRock and Vanguard dominating the ETF landscape, questions about market influence and fairness are bubbling to the surface. In the tech-savvy corridors of the U.S. stock market, a new phenomenon is reshaping the landscape. Meet the Magnificent Seven: Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla. These tech titans command nearly 30% of the S&P 500's total value, making them pivotal to market movements. Their sheer size poses concentration risks. Any significant shift in their fortunes could ripple through the entire market. On a parallel track runs the bond market, another vital component of the financial engine. Here, investors lend money to entities, ranging from corporations to governments, in exchange for regular interest returns and the promise of principal repayment. Bonds vary widely, from ultra-secure government issues to the alluring yet risky high-yield corporate bonds. Central to this market is the concept of credit risk, the probability of a borrower defaulting. Bonds are rated for risk by agencies like Standard & Poor's or Moody's, with higher-rated bonds offering security and lower yields, while riskier, junk bonds entice with higher returns. In this complex tapestry of stocks and bonds, certain institutions exert extraordinary influence. Their roles, often understated, are pivotal in shaping not just markets but the broader economy. Understanding these intricacies isn't just for the financial elite, it holds relevance for anyone navigating modern fiscal landscapes. Balancing economic forces. Central banks hold a pivotal role in shaping economies, impacting everyday life from the cost of a simple cup of coffee to job availability. In the U.S., the Federal Reserve, or the Fed, stands at the helm with a dual mandate, maintaining price stability and promoting employment. This requires a delicate balance, akin to an epic tightrope walk. To navigate these dual goals, the Fed employs various tools. One such tool is the reserve requirement, which sets the minimum reserves banks must hold. By adjusting this requirement, the Fed directly influences how much money banks can lend out, thereby either stimulating or slowing down the economy. Additionally, open market operations allow the Fed to regulate money supply by buying or selling U.S. Treasury securities, which nudges interest rates in a favorable direction. Quantitative easing, QE, is another strategy where the Fed buys securities to inject liquidity into the banks, lowering borrowing costs and stimulating economic growth. Conversely, when it's time to cool things down, quantitative tightening, QT, comes into play, selling these securities to reduce market liquidity. The Fed's reach extends to setting the discount rate, the interest rate it charges banks for short-term loans. A low rate suggests banks should increase lending, while a high rate signals caution. The interconnectedness of the banking system is also manipulated through the federal funds rate, affecting overnight loans between banks. Although the Fed doesn't control this rate directly, it uses other instruments to guide it. During challenging times, such as the COVID-19 pandemic, the Fed showcased its immense power by cutting interest rates to zero and executing massive securities purchases to flood the market with liquidity. These actions were designed to bolster the economy by providing extensive support to businesses and households. Yet, despite its influential arsenal, the Fed cannot manage the economy with absolute precision. The effects of monetary policy unfold over unknown durations and do not grant the Fed the luxury of complete control. The interplay of these policies truly embodies a blend of art and science, as decisions rely heavily on interpreting imperfect forecasts about the future.
Kyla Scanlon's In This Economy distills the intricacies of economics into a comprehensive narrative that shines light on both foundational concepts and modern complexities. From understanding money's value and creation to examining the influential role of central banks, you'll gain a clearer perspective on what truly impacts the economy. The book challenges the supremacy of traditional economic indicators like GDP, advocating for a broader understanding that incorporates social and technological factors. It also highlights the risks and opportunities within stock and bond markets, emphasizing the implications of market concentration and credit risks. The discussion on central banks underscores their critical balancing act in managing economic stability. Overall, this journey through the economic landscape equips readers with essential insights to navigate our interconnected world better, fostering a more informed and holistic view of economic dynamics and encouraging proactive engagement with ongoing global shifts.